Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Gerald Celente is publisher of the Trends Journal, and he's founder-director of the Trends Research Institute. He is online at trendsresearch.com. He joins us today from Kingston, New York. Hey, Gerald, it is always good to talk to you.
Oh, thanks for having me back.
Latest trend alert, Death to America. We have all heard about this YouTube movie that has most of the Muslim world up in arms and the tragic events in Libya. Easy to tie these things together, and in fact, that's exactly what most of the media is doing. What is the real story here, Gerald?
The real story is what I wrote about in 1996 in my book Trends 2000, national bestseller, Warner Books. I wrote about Crusades 2000, and I wrote about how, that we were going to see uprisings around the world throughout Muslim countries as they overthrew their dictators who were being supported by the United States. It's called foreign policy. It's foreign, actually, than anyone would call it policy. And again, it's very clear. I hear people like this Rudolph Giuliani, there's a former mayor of New York. How dare anybody say that it's American foreign policy why they keep attacking us? They hate our freedom and liberty. Like, what am I, 6 years old? Who are you talking to? Here, this is what I wrote, Phil. Remember, this is 1996.
Okay.
The seeds of the new crusades were sown in areas of Africa, the Middle East, Eastern Europe, and Asia. Throughout the Muslim world, devout masses, politically repressed and impoverished, there's your key word, impoverished, were rising up against their endemically corrupt and inefficient secular governments with their pro-Western alliances. Imperialism, directly or indirectly, took the blame for the poverty, the lack of opportunity, and the social and moral decay. Disenfranchised, desperate, politically powerless Muslims in many countries looked to charismatic clerics to change their destiny. I've been writing about this for years.
Mm-hmm.
You're going into these countries, you're killing their people, stealing their natural resources, and then propping up puppet governments. They don't like it after a while, And America keeps doing it. I get a kick out of Obama, the Nobel Peace Prize winner, who decides he's going along with two other chicken hawks, Sarkozy at the time, the former French president, and Cameron, the other chicken hawk, are going to decide they know what's best for the Libyan people and overthrow a sovereign government. And everybody's saying, oh, it's that movie, I tell you.
Mm-hmm.
That's why they attacked the American consulate. That's the administration's line. Obama keeps saying it. Carney, their mouthpiece, he was saying it. Susan Rice, the ambassador, the United States ambassador to the UN, she's saying it. And now he's saying, oh, maybe it's Al-Qaeda. Yeah, that Al-Qaeda, he's always out there. How about the people in Libya that hate the new government that were former supporters of the Gaddafi regime?
Sure.
Could that be possible? No, not in the world of the United States of America, where they hate our freedom because of our liberty, and that's why they want to attack us, and all we're trying to do is export democracy. So this is what's going on. It has nothing to do with that movie. That's like saying that World War I began when they assassinated the Archduke Ferdinand.
We are talking to Gerald Celente here on This Week in Money, and we've got some news today. You mentioned Jay Carney earlier from the White House today, the press secretary, calling this a terrorist attack, the latest optics on what's going on there.
Yeah, they changed the story.
Yeah.
How could the propaganda mill just keep spinning, and you never know where it's coming from? And again, I could go back, Susan Rice, Libya protests hijacked by extremists. She said it had nothing to do with anything else. They still love us around the world. Jay Carney comes out, and he said first it wasn't a terrorist attack, and now, of course, he's saying it is. So the spin machine never stops.
You'll be glad to know they've just created a panel, Gerald, the Accountability Review Board, to investigate what happened in Libya.
Well, they'll get to the bottom of it.
We are talking to Gerald Celente here on This Week in Money. You mentioned earlier the first great war of the 21st century underway. You cannot have a war without weapons, right? Here's China's Prime Minister Wen Jiabao in Brussels says China is going to help the European Union and their financial problems, but he is not happy, wants to talk about that little embargo embargo on weapons sales?
Well, the United States keeps supplying, China's enemy, like Taiwan, with a lot of advanced weaponry, and China claims that Taiwan is theirs. And also what's going on with the United States supporting the Philippines in the dispute in the Spratly Islands in the South China Sea. And now you see the United States opening up bases in Australia and plopping them all around the South Pacific. So, the United States waged losing wars in Afghanistan, had a real big loser in Iraq, it cost 5,000 U.S. soldiers' deaths, tens if not hundreds of thousands wounded, whether physically or emotionally, definitely spiritually for life. Just killed over 1 million Iraqis, destroyed their country. They're losing in Afghanistan. And now they're brilliant. They're going to go start another war, and they're planting the seeds for one against China. And you could even hear the war drums heating up with the rhetoric coming out of the campaign in the U.S., with Obama now blaming China for unfair trade practices. Yeah, no kidding. And Romney jumping on board with it. And here's the scenario. We've seen this picture before. You go back, the crash of 1929, the Great Depression, currency wars, trade wars, World War II. The panic of '08, the Great Recession/Depression, currency wars, they're going on. Trade wars, they're heating up. World war, it's happening already. Yeah. There's a war in Libya, a war in Syria, a war in Yemen, a war in Bahrain. Millions of people are marching in Spain and Portugal that does not make the news in the United States. You see what's going on in Greece. You're seeing the collapse of Slovenia. One country after another, Ireland, Portugal. When are people going to wake up to see what's going on?
Gerald Celente, our guest here on This Week in Money. Speaking of Mitt Romney, I can't finish off the show here without getting your take on the 47% speech. Romney telling donors at a $50,000 a plate fundraiser, nearly half of Americans believe that they are victims.
I'm a victim. I'm a victim of people like Romney and the rest of these corporate vultures that grabbed everything for themselves. Corporations were owned by the stockholders and the people that founded the companies. No longer. They're owned by hedge funds and private equity groups. It's guys like Romney that are grabbing all the dough, and then there's a guy, this is a little another chicken hawk, a guy that talks tough about going to war and doing this while he's hiding during the Vietnam War. He's my age. In France, in southern France, trying to, I love it, as a Mormon missionary. Oh yeah, Mormon missionary in all Catholic, cigarette smoking, wine loving Brigitte Bardot France. Oh, they're ready for you, Mittens. And here's a guy that's born on third base and thinks he hits a triple and has the nerve to call other people that don't have anything victims.
I love this comment, Gerald, in the New York Times. Nick Kristof pointing out that American soldiers don't pay tax while they're in combat, and they might rely on government benefits when they come back. I guess they are victims, too.
They're victims. The people on Social Security are victims. The people out of jobs are victims. You look at the numbers. I'm not making these numbers up. Since 2009, median household income in the United States, since the beginning of the Great Recession in 2007, median household income in this country has dropped by over 10%. You're looking at a loss of wealth across the board. People have had their pensions and their futures wiped out. And here's the other disgusting thing that goes on in the USSA. You have people that have lost their jobs, they're losing everything, and now all of a sudden they're losing their homes because they can't pay the exorbitant property and school taxes. And then you have a guy like Romney, again, a little rich boy, little spoiled little boy who talks out of like a big shot. And the other thing that they didn't talk about, that they're not talking about a lot, that came out of that speech, about how the Palestinians don't want peace. Let me get this straight. Weren't the Palestinians there before the Jews were there? I mean, didn't they just take that land from them around the late 1940s?
Yeah.
Oh, no. Don't you know your Bible? The Jewish people were there 2,008 years ago or something like that. And having the nerve to say that the Palestinians, who they're being treated like in an apartheid state, having no freedoms, having their land stolen from them continually, living in a virtual concentration camp, having the place all boarded up and closed off and sanctioned. They don't want peace.
We have some more Romney news just in. A former Minnesota Governor Tim Pawlenty quitting the Romney campaign today. He's going to become, guess what, Gerald, a lobbyist for Wall Street banks.
You know, this is why I hate politicians. I'm a political atheist. I don't believe in politics or political gods. Everybody's entitled to follow their political gods and do what they believe. But this Pawlenty's another little example of another little man with a big mouth. This clown was yapping it up when he was trying to run and get the GOP nomination to run against Obama, how he was going to get tough on the banks, how he was going to clamp down on them, and now he's sucking up and bowing down and taking their money like any other good whore would do. And that's all these people are.
The real irony, Gerald, here from Mitt Romney reacting to Pawlenty quitting, said his new position as a lobbyist, advancing the integrity of our financial system, is vital to the future of our country.
Oh, yeah, he's right. You know, it is. The financial system, the Goldman Sachs gang, the Merrill Lynch mob, the Goldman Sachs criminals, you know, the Citigroup crooks, John Corzine, who's the head of MF Global, can't find $1.2 billion, former head of Goldman Sachs gang, you know, one after another. And you know how many of them got prosecuted under the Obama administration?
I'm guessing 0.
You guessed right. And it couldn't be, by the way, because Eric Holder, the Attorney General, for example, was a member of one of the biggest white shoe boy lawyer firms that protects the white-collar crime criminals, and MF Global, the company that John Corzine brought down that can't find $1.6 billion, that couldn't be the same law firm that represents MF Global, could it?
I think so.
The whole game is rigged, and it's a criminal operation. I am not voting in this election. I will not vote for a lesser of two evils. I don't go out with them. I don't do business with lesser of two evils. I have nothing to do with lesser of two evils. I'll be damned if I'll vote for one to run my life and run my country.
Gerald Celente, publisher of the Trends Journal and founder, director of the Trends Research Institute. Put your money where your mind is and subscribe. You can have more info at trendsresearch.com. Don't forget on Twitter, Gerald Celente, on YouTube, the Gerald Celente channel. And Gerald, you're going to be at the Seed event coming up here in Vancouver in October 13th to be precise. What's going on there?
Yes, I'm going to be one of the keynote speakers there. It's a great group. These people do wonderful things. And it's not the kind of venue I usually speak at. I'm usually more in the business realm, but this is really more applicable to really what I believe in the terms of a holistic approach to life. And they have a number of wonderful speakers there, including Deepak Chopra.
Wow.
And exhibits. So it's one of the ones that I look forward to attending each year myself.
Seed event in Vancouver, October 13th, and more info at seedevent.org. Gerald, always a pleasure. Thank you for talking to us today.
Oh, thanks so much for having me, Phil.
This Week in Money is archived online at talkdigitalnetwork.com.
Marin Katusa is Chief Energy Investment Strategist at Casey Research. He is Senior Editor of the Casey Energy Report, and he is online at caseyresearch.com. It's always good to have you back here on This Week in Money, Marin.
Thank you.
Hey, it's been a heck of a week in a number of different areas. We're going to talk about something that's a total surprise to a lot of us, but let's start off with what's going on in the headlines. Oil up over $100 last week, a 4-month high. This week, a different story. It's down more than 5% on the week. Everything started going nuts on Monday. Tell us what happened.
Well, basically, it's a battle between the bulls and the bears. You know, we're talking about the shortage, the economy's going good, QE, quantitative easing. You know, it's injected, you know, the financial heroin into the markets. But then Saudi Arabia is saying, well, let's hold on a second here. We don't want to get, you know, too out of control here. So the market's just stabilizing itself. A lot of profit taking's been happening right here, and the markets are just trying to find its stabilization point.
Now, they're calling this thing on Monday a flash crash, price dropping $5 a barrel in just a matter of a few minutes.
Yeah, you know, and it could be people unloading their bets, hedging themselves.
Sure.
So, it is what it is, and it got ahead of itself a little bit there once it peaked over 100, and, it was quite obvious to everyone. It gapped up quick, and it just gapped right back down.
Let's talk about the different kinds of oil, and then we're going to talk about what you and I chatted about earlier, a huge surprise for a lot of folks, and we're going to focus on that later. But first I want to talk about oil, and we forget that when we talk about oil, there are different kinds of oil. There's West Texas Intermediate that we're familiar with, and that's trading quite differently from Brent crude, which is the European standard, and the two are affected by different things. Let's start with WTI. What's going on with West Texas, and why?
Sure. So the WTI is what we call the North American pricing, or the U.S. pricing. And even within the WTI, you have different types of oil within a localized regional market. Now, the main reason why WTI is trading at such a lower differential than the Brent mainly is the political risk right now in the Middle East. Now, most of the European imports are coming from the Middle East, and there's that political premium risk associated to that. Number two, the Americans have been very, very successful with their shale oil, and on top of that, within their own regionalized market, between the Eagle Ford, the Bakken, the Marcellus, all these different regions with the unconventional shale oil production, domestic oil costs are going down. Now, that said, within the North American market, you have heavy oil, which is our Canadian oil sands. You have your medium, and then you have your light sweet crude, which is the WTI kind of benchmark. So there's that's the difference. And then within that, you have even lower differentials, and that's why our Canadian oil sands get such a lower oil price than the WTI, because it's a much heavier oil, and it costs more you get paid less from the refineries, because it's a heavier crude, which means it takes more energy to upgrade it.
Now, we're talking to Marin Katusa here from Casey Research. He's the energy guy, and a lot of the problem with the West Texas Intermediate seems to be the flow of oil. It turns out that the oil is flowing in the wrong direction. Is that true?
Yes. We've written about this about a year ago in our newsletters, and we talked about, for the Canadian oil sands, for example, we got to go through the Bakken to get to where the refineries are. But now in the Bakken, there's an oversupply of the oil, and that's why these differentials are appearing, because the refineries can't handle all the product. Now, when the Keystone XL pipeline comes in, and eventually it will, but it's going to take longer than the market expects, and it's going to cost more than the market expects, but it will happen. And when that does happen, our Canadian oil can bypass that, and we can start getting a better priced per barrel than what we're currently getting.
Problem seems to be we have a glut of oil here in North America, and we're having trouble moving it around.
That's right. And, when we bring in the West Coast terminals and the pipeline, it will also be built, because the reality is the governments understand that they're doing this, and the natives will eventually get on side. It'll take some more time, but once we get to that point, the Asia markets will be lining up for our Canadian oil sands. And I say within 10 years, we'll have both the XL and the West Coast shipping to Asia happening.
We're talking to Marin Katusa from CaseyResearch.com here on This Week in Money. Not just the West Texas this week taking a pounding. The Brent, the European oil, also sliding to a 6-week low today. What's going on with Brent? What kind of factors are at play here?
Well, a few things. 2.5-3 weeks ago, there was a lot of talk out of the Israeli newspapers saying how the Israelis are preparing, buying gas masks, and preparing for an attack on Iran. It started creeping up with the quantitative easing. The speculation increased. The financial heroin came in. And all this speculation was propping up. And kind of now the market's kind of eased down, and they realize that with all of these horrendous acts against the American embassies, that a war hasn't started, and Israel hasn't attacked Iran yet. So the markets are starting to profit take, and then the reality is the global economy is cooling down. In the world, there's enough supply currently to meet the demand and more, and we're looking at supply surpluses, and hence why we've taken a step back. But the long-term picture, if you're looking out 5 years, there's only one place oil's going. That's a lot higher.
Now, there's a lot of actors when you talk about the European oil prices. A lot of actors in this movie besides Iran. There's Angola, there's Nigeria, there's Algeria. The list seems practically endless.
Yeah, the OPEC countries. But remember, when you look at Venezuela, Chavez and his group have financed their social programs from these premium oil prices. Mm-hmm. Saudi Arabia needs $80 oil to balance their budgets, and they're investing so much money, just as America is with the QE and Europe is with their bailouts, into social programs, infrastructure for the social. There's so much money getting plowed into the social sector here that, we're not going to see $40 oil. And I have a bet with Porter Stansberry on 100 ounces of silver that in May, so in about 7 months, that he thinks oil will be $40. I do not see that. I'm a long-term bull in oil, and the daily fluctuations aren't what investors should be focusing on. The trend is your friend, and the cheap oil, the $30, $40 oil, is gone.
How's all this affecting, Marin, the price of energy stocks?
Well, you got to look at a localized, it's a very localized market. So if you look at natural gas in North America, a year ago everybody was talking about NGLs, natural gas liquids. We've told everyone be careful about that because there's eventually going to be a glut of NGLs. That's now occurred. So you're seeing these revenues coming in a lot lower in North American production. Now, even though the Henry Hub price is touching $3 per MCF, now again, the Canadian price, the AECO price was, $1.80 to $2. So there's a huge differential between that price. So as an investor, be careful. Just because the WTI is touching 100 and the Henry Hub for gas is at $3, that does not necessarily mean the company you are investing in is selling their oil for $100 or selling their gas for $3. It is a very localized market, so be very careful. And on top of that, the market right now is risk off. They don't want any trouble with these juniors missing these wells. Mm-hmm. They're chasing yield. So a lot of the market investors, the big hedge funds, the sovereign wealth funds, they just want to earn some sort of yield on their money, and they're willing to pay a premium for a yield.
We're talking to Marin Katusa. He is Chief Energy Investment Strategist at Casey Research, and you and I were talking off the air, saying there is something much more important in your view going on than is happening with oil, and very few people are talking about it. Tell us what's going on and tell us what it is.
Well, first off, I was on BNN yesterday. They asked me to break the story for the markets, and the coal market is broken down. In just the last 2 months, we're seeing 40% lower prices. 40%. Wow. That's the same as within a month and a half or 2 months, oil dropping to $60. The difference here is most of these North American mines are not economic. Alpha yesterday announced they're shutting 8 mines down. The reality here is because of the success of the shale gas, the North American thermal coal market has taken a beating because thermal coal is used to generate electricity. Now, we've been saying this for over 18 months. Be careful about the coal sector. We are now reaching that point. So, for example, coal that was expected for $150 now is trading around $65, $70 if you're lucky. Hard coking coal, which just this time last year was $300, it just traded last week for $140.
Ouch,
US
that's half. That's half.
That's over half.
Yeah.
So now you're looking at this going, wow, these companies cannot make money at $140 coal. So the next 3, 4, 5 months is going to be a very volatile time for the coal producers, the coal explorers, and it's going to be a reality check. Now, we've talked about the reserves and resources of these companies. The value of these deposits is all dependent on what price you're valuing the material in the ground.
Sure.
And we've talked about this for over a year, and in the gas market, there's a reserve write-down coming. And unfortunately, in the coal market, most analysts are still using plus $200 per ton for met coal. Well, guess what? It's trading at 140, and it might even go to 120. At that point, a lot of these explorers and development projects do not work. 50% of the seaborne production loses money at this point, And, Canada's largest diversified miner, Teck Resources, will be in big trouble. But at that point, remember, the cure for low prices is low prices. And at that point, we're going to be very excited because we're going to be picking up our favorite coal stocks at a huge discount.
Yeah. What about the coal that's already in the pipeline? Where I live here in Vancouver, I see coal going past my house every day, trainloads of coal. Have a lot of these producers got contracts locked in with Asia?
Yes, they do. And on top of that, the contracts these companies are not going to make money at these contracts because at the spot price or even at the benchmark price, which is 170 right now, the buyers, the end users, remember, all of the met coal that we produce in BC that goes to the West Shore Terminal is going to either Japan, China, or Korea. So that's our market. And right now there's a lot of problems in China with the steel production, and met coal is used for steel production, whereas thermal coal is used for electricity generation. So yes, it looks like a lot of trains are going through, but remember, that's to meet the stockpiles, that's to meet the shipment commitments that they have, and more importantly, every coal, cargo that you see going by, you can count a lot of tons that they're losing that they've produced. There's a lot of money being lost right now.
Long term, Marin, are you bullish or bearish on coal?
Long term, very, very, very bullish. Remember, still today, over 40% of America's electricity generation comes from coal. The reality is as these markets do get through this global, as Doug likes to call it, a greater depression, the reality is people are going to move on. Just as we got out of the 2008 recession, the global demand for high-quality met coal will still be there. The next 5 months is going to be a very difficult time for these producers, and you're going to see another 25 to 30% price decrease in these producers, and at that point, you're going to be able to collect a nice dividend, and you want to be invested in the lowest cost producers that can make money at $150 coal, because that will be the longer term price for met coal.
Keep your eye on coal. You heard it first from Marin Katusa. He is Chief Energy Investment Strategist at Casey Research. He's online at caseyresearch.com. And the Casey folks are also on Twitter and Facebook, by the way. Don't forget, audio from Navigating the Politicized Economy. The recent Casey Summit in San Diego is available. Marin was there along with a lot of other good folks. The CD or MP3 download info is on the Casey Research website. Hey, Marin, as always, fascinating, my friend. Thank you for your time.
Always a pleasure.
This Week in Money is archived online at talkdigitalnetwork.com.
Danielle Park is president and portfolio manager of Venable Park Investment Counsel. She wrote the best-selling book, Juggling Dynamite, and you can find her online at jugglingdynamite.com. Next week, Danielle is at the Toronto Resource Investment Conference, and you can register at cambridgehouse.com. Hey, Danielle, welcome back to This Week in Money.
Thank you, Phil.
Economic news in the fore today. Canada's economy, we might as well start here at home. We're stuck in a soft patch. That's according to the TD Bank's Craig Alexander, who says we're at a crossroads, but hey, good news, 2013 is going to be better.
Wow. Do I ever disagree with him? I think that's wonderful that, he's acknowledging we're in a soft patch now. The problem is that so many analysts, commentators, and economists only acknowledge the soft patch when the evidence becomes pressing down upon them. They don't have any ability to see these things coming for some reason, and as a result, they're always surprised, and then they always, when the weight of the evidence is quite profound, they typically say, well, it's bad now, but we think it'll be much better in a couple of months. I think it's going to be significantly weak over the next few months, perhaps 6 months. And I think that is the downside risk to the asset markets at the moment.
All due respect to Craig, it's kind of like the coyote looking up at the shadow of the giant rock just about to fall on his head, right?
Terrible. Well, they're notorious because, the long always institutions are in the business of keeping people in securities.
Sure.
Unfortunately, they aren't paid to look for the bad news, which is that prices are probably exceptionally overvalued at the moment.
We have more grim economic numbers from across the border. U.S. manufacturing suffering from the weakest quarter in 3 years. Number of folks filing for unemployment claims near 2-month highs last week. And more bad news from the Conference Board. They say, hey, not much growth ahead.
Well, this goes back to why we may have seen this capitulation in the central bankers of the world last week, where the Federal Reserve followed Draghi's lead from the ECB and basically said we'll try and stimulate for as long as there's breath in our bodies. And I think that part of that was they had a sense of the data. They supposedly monitor this stuff, and the forward-looking information is pretty much completely dire at the moment. I think you and I talked about this last week. I said I had a sense of relief that they finally announced the QE3 program, because I felt that once that news was out, people would not be able to be distracted any further by what gimmicks the Fed would bring and would have to actually refocus on the economy. I think that's what we're seeing right now. We had a few days of some upward movement, and basically asset markets have, just gone flat at the moment. Commodities, which is an important indicator of future growth expectations, are actually off about 4%, Phil, from last week's QE3 announcement. And meanwhile, last week you had the longest speculative long interest in commodities that we'd seen in 16 months. So again, the traders were, I think, expecting more of the reaction of the last couple of QE programs, which was lots of money flowing into commodities and risk assets. But the exhaustion syndrome seems to have hit in, where everyone that was going to buy on that theme is basically bought. And now we continue to look at things like China's news last night. Their economy slowed for the sixth straight quarter. That's more than a year and a half. Their stock market went back to Feb 09 lows last night in a significant downturn. So I think that's the story, and we're going to keep getting more evidence over the next few months on that regard.
We do have some stimulus going on this week. The Bank of Japan whipping out the stimulus wand, $126 billion. That sounds pretty good. I like it better when they calculate it in yen. 10 trillion yen. That sounds like a whack of cash, doesn't it?
It's a lot, but they just keep adding zeros in the wrong direction in that country. And the real incredible thing is the thing that saved them, that allowed them to continue with these unsustainable deficits over the last 20 years, Phil, was that they went into it with a very high savings rate domestically in the population. So they were holding a lot of their own bonds. Now they've got the scenario where that aging population is cashing in those bonds because they can't make any interest or income. The stock market hasn't made them money in years, and the bond market's paying them next to zero. So the reality is people are cashing in the bonds. So what's happening is that they're now in a negative cash flow scenario, which is only compounding the fact that the world's in recession again. So you saw that the Nikkei sold off even on the news of this renewed stimulus program. I think that people have finally figured out that the stimulus, in terms of stimulating economy, is basically ineffective.
We are talking to Danielle Park from JugglingDynamite.com here on This Week in Money. I want to point our podcast and radio friends to a trio of great videos on your website about China. You've got Tom Friedman of The Times, Jim Chanos, and Gary Schilling, all talking about what's going on in China. Fascinating stuff.
Yes, well, I guess we put a lot of faith and hope in China over the last 10 years, let's say, because we knew that, they entered the World Trade Organization in 2001, and this was a new dynamic and this insatiable population that everybody was looking at saying, wow, they're really going to drive demand, and they certainly did. I think in retrospect, however, that demand certainly peaked out in 2007 with the credit bubble. And after that, we've seen weaker demand across the board, except for these episodes of stimulus out of some central bankers. And when you saw that, you saw, a bunch of money flowing into commodities and flowing into, currencies that were risk-on currencies, that sort of thing. What you see now is that China has a ton of social pressures internally. It has this standoff with Japan, which is just insane, frankly, at this particular time. And you've got this big cavitation in their growth rate. So, it's still officially estimated at 7.5 from the previous 10, but actually the growth rates look more like 5% perhaps over the next while, in which case that will continue to bring a lot of social unrest and unhappiness in the country, just as their cash flow is, again, the cash flow is king in this environment. Cash flow is falling off because their exports are diminishing. And again, this is not something that can be quickly turned around. It's not something where, a quick injection of anything is going to solve it. We've had a couple of years where that was the mainstream belief, that you just needed more liquidity. And I think now we're at the point where people realize that liquidity isn't solving these problems. So what it goes back to is, what domestic economy strength does each country have? What savings do they have? How did Japan get through the last 20 years? Because they started with a lot of cash in the pockets of their population. So when you look at China, they definitely don't, right? They have an emerging middle class, but the bulk of the people are very poor, and the average earnings was very low going into this downturn phase. It's back to this idea of North America actually has an advantage as we head into this next downturn, because we are relatively wealthier here in a domestic sense, and we have a higher birth rate and a higher immigration rate than any of those other countries. And so that will give us some ability to generate domestic demand. And so here's the next piece to that puzzle, Phil. The piece that I put on the blog this week about Bristol, England, and how they're printing their own pound. And it may strike people as a really crazy idea, but really, this is exactly the conversation I've had with several people in the last couple of years about the big box stores, right? How big box stores like Walmart and all the chains basically turned the entire country or continent into a bunch of towns that all look the same, right? You go through any town in America or Canada and you basically have the same, 8 or 10 franchises, right? And what happens in those companies or stores is that they take their profits and siphon them out and give them to foreign investors or investors in other cities. So what you lose is a purchasing power effect in your own town or community or state. And so Bristol has got this idea and put it into, it's a very protectionist idea, and many economists will say, oh, this is horrible. This is definitely the wrong thing. You don't close down your trade with outsiders. You try and keep that going. But in a post-credit bubble world where everyone has less cash, this is an inevitable trend where people start to realize, hey, if I give my, $10 to the baker in my community, then he's going to take 3 of those bucks and buy something from the florist in my community, and around it goes. So I think that this is the reverse globalization that is going to continue over the next while.
We are talking to Danielle Park here on This Week in Money. U.S. Senate holding hearings today on high-speed trading. You've been on this one for a while. They want to see if it needs more regulation. And there's a new Chicago Fed survey, not pulling any punches here. They're saying algo trading is basically what you've been saying. It's out of control.
Well, and it's absolutely indefensible. There is no good argument other than the exchanges want to keep taking commissions. They want some trading volume because they've basically pushed out any legitimate trading. Between the reckless rules and wild computers running the trading on the existing public exchanges and the Federal Reserve, inflating so that asset prices make no sense on a fundamental basis when you connect it back to growth in the economy. Those two things have pushed out legitimate investment interest from the major markets in the world. And everyone that cares about the economy, real growth, actual revenue and business has to care about that, because they need to get the confidence back in the public marketplace. They need to bring investors back. What's going to do that? Thwarting some of these insane activities that have been left to run amok. That's the first thing. And the second thing is to let asset prices find their own organic value in this new growth environment, this new slow growth environment. So I think this is definitely an idea whose time has come. And here's my little forecast about the future, Phil. Okay. I can't tell how quickly this will happen, but I'm quite sure that they will eventually come to ban this form of high-frequency trading, or they will tax it in such a way that it's no longer profitable, or they will expand the bid-ask spread so that they can't continue to run the system the way they've been doing. And that will be, that will come at a moment of public just revulsion at how corrupt and lopsided the system has become, and that'll be a step back to the healing process we need to see.
Hey, it's been a while since we've heard from Lloyd Blankfein. Remember him, the CEO at Goldman Sachs in Toronto yesterday, says if more inflationary expectations seeped into the world, that'd be positive for the economic system. Is he right, or is that just vampire squid talk?
Oh, he's right in the sense of he's the king of the overinflated asset pile, and he likes to keep that train out running. The whole business model of the investment banks over the last 15 years has been to lever up, to force asset prices up, and to do it on 20, 30, 40, 50 to 1 leverage so that they make enormous profits off of things that shouldn't be making that much money, that really doesn't make any sense. So they have had a great gig, and that gig is now up on a whole bunch of fronts. They have diminished investment participation from their clients, who have increasingly become less tolerant of the abuse that they've got at the hands of these investment dealers. There's a capital outflow that's happening in the system. At the same time, you're having increased regulation, which is necessary in response to the period of vacuous legislation that we went through. And you've got them basically having to cut tons of staff now to adapt to this new lower growth, lower revenue environment. So they don't want to face a world, the reality of a deflationary trend in asset prices is a very scary prospect for institutions that are used to just levering up and making huge profits. So this is a whole new dynamic. So I could see why he would be hoping for a return to inflation anytime soon.
Danielle, I don't know if this is good news or bad news. U.S. government study reporting 2011's seafood catch, the largest in 17 years. I guess that's good news if you like seafood, but bad news if you are seafood.
Yeah, exactly. I think it's there's a commercial that just makes my stomach turn. I think it's for Red Lobster, and it comes on and it says endless shrimp.
Yeah.
And days of endless shrimp. And I think to myself, is that not exactly the problem right there? There's nothing endless about what's in the sea, and there's nothing endless about what you should be eating either. Let's face it. Demand for that kind of food, if you eat too much of it, is obviously not good. But yeah, so this mentality of endless and gorging, and I think we're in a new dynamic here where people are going to be increasingly more interested in frugal sustainability, less is more kind of ideas.
Danielle Park is president and portfolio manager of Venable Park Investment Council. She wrote Juggling Dynamite and Insider's Wisdom on Money Management, Markets, and Wealth at Last. And you can always find her fascinating blog at jugglingdynamite.com. Hey, thank you, Danielle.
Hey, you're very kind. Thanks, Phil.
Thanks to our guests, Gerald Celente, Marin Katusa, and Danielle Park. And thanks to you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.